Welcome back to my channel, Balance Sheets Matter. In this video, we're going to be doing a stock analysis on Match Group. So Match Group is basically a conglomerate that owns a lot of the different dating websites out there that include, for example, Tinder, Hinge, OkCupid, Plenty of Fish, and a lot more, not just in the US, Canada regions, but in Asia and a lot of other countries as well. But before we get into the stock analysis, of course, make sure to subscribe to my channel, Balance Sheets Matter. I do individual stock analysis videos, so if you like getting good ideas of potential stocks to buy or value traps to avoid, make sure to subscribe to the channel. And if you do want me to look at a video, you can drop it in the comments below, as I do sometimes get to subscriber requests. So now let's dive into the stock analysis on Match Group here. So Match Group's sitting at a little bit under a $10 billion market cap. So even though they are kind of the conglomerate of this, they aren't the biggest market cap in the world. And looking at a few of the top level metrics, you can see PE is sitting at a pretty reasonable 15.61, although the forward PE is only sitting at 15.37, implying there is a relatively low EPS growth projected in the next year, basically going forward. And you can see there's a little bit of a dividend yield right now of 1.92%. So we're going to see if that's going to be a maintainable dividend going forward in the future with a very manageable payout ratio of 0.28. And you can see basically there has been a 3-year basically where's the shareholder yield here? The 3-year average share buyback ratio of 6%. So, compared to a lot of other stocks, it's actually pretty high. And, they have been buying back a lot of shares like that. So we're going to dive into the 30-year financials. And the one thing you can see, there's kind of some ups and downs that basically have happened in the revenue. So if we kind of look on the 10-year front, it was negative 3.3%. But if we look at the 5-year, it's been about 7.6% of basically revenue growth per share. So that is one thing you kind of have to keep in mind with a lot of different companies, that if they don't have consistent revenue growth, even though on the chart here, this is what's projected going forward in the future, that's obviously not necessarily a guarantee, although, it very could well stabilize and be that in the future, since before in the past, if look pre-2000, well, internet and all this internet dating basically really wasn't a thing, and it's kind of more become a more normal thing in basically in today's world, unless there's going to be something that's going to come out and kind of disrupt this. But even if they kind of does, since they have all the kind of existing dating sites already, they would probably acquire anything new that basically would come out there forward in the future as well. And aside from the revenue growth, you can see even though over the 10 years, the EPS growth actually has been going up at 9.4% per year. And that's a growth rate per share, which does include the share buybacks. So we get into a few of the top level metrics. One interesting thing to look at is basically return on invested capital. And one thing I think that is looking very good for Match Group is they actually have able to improve this quite a bit over the years, and it's sitting at 22.44% with actually a pretty low average weighted cost of capital of 7.8%. So if they did want to kind of build out their company more, their platforms, they do get returns on that. But being kind of an online dating site or a conglomerate of online dating sites, I don't really see this being super relevant to them. If more anything, they're going to be doing acquisitions of potentially other sites out there to build into their portfolio. Now, if we look basically over the history of the revenue here, you can see kind of around, COVID and everything there was a really big boom, and this caused a really big increase in the stock price. And I'll just pop over here. You can see basically like they were already going up, but they had this really kind of temporary parabolic boom basically in 2021, from 2020 to 2021. And then after 2021, they've really fizzled out and come down quite a bit. And, you can kind of see basically what happened is, the revenue went up. And then basically in 2022, they're not growing at this, hyperbolic rate, kind of going from about $2 billion to almost $3 billion in 2021 is, quite high growth. And then teetering out to this lower rate is kind of more what they're normalizing in going forward now, because then in basically 2023, it was 3.3 billion, December, 2024, the year ending then, was 3.4. So they're still growing. And right now in the last basically current year, they're at 3.5 billion. So they are growing, but it is at a lot slower rate. And we'll get into some of the analyst estimates later in this analysis. But the one nice thing is basically the gross margin still maintains very high, despite the slower growth. Basically, the gross margin is at around 74%, which is basically pretty close to where the peak is. There have been, some years when it was higher before, but definitely compared to a lot of the averages, this is much more in the upper range. And the next important thing to look at is basically their other operating expenses, like, selling and general admin. And you can see selling and general admin is really basically just, operating expenses of their staff to basically, maintain these platforms and do everything else there in the background. And the one nice thing to basically see is if you kind of look really far back when here, basically in 2016, there was some restructuring on down since they basically slashed this absolutely down to nothing, and it's been growing back up again. But overall, in this long run, they have actually been able to kind of grow this revenue without having the selling and general admin basically get a little bit out of control, which for a lot of times companies, if they do have slower growth, the one big thing that can creep up on them is things like selling and general admin and that type of overhead, because inflation will outpace their growth and will squeeze their margins. But we're not seeing that with basically Match Group at all. And right now, their operating margins are sitting at very close to record highs again. And back here was a little bit over 31%. But they're sitting at 28%, which is very very solid, and it's definitely, I would say, is not in a downtrend at all. So those are some things I do like that I'm seeing in basically Match Group here, is that the margins are looking really good. I like the operating margins. You can also see there's a little bit of research and development that goes in. Not the biggest expense, but they actually have been upping it in the last few years. So that's kind of interesting. So it does show they are kind of trying to develop their current platforms a little bit more and maintain, I guess, the market share through that. But it's really nice seeing these high operating margins. So even if they are expected to basically have a little bit slower growth going in the future compared to some of these bigger booms they basically had in the past, if they're maintaining these high margins, this is basically a really good sign. Next thing to look at is basically the net interest expense. Net interest expense is sitting at 130 million. They are creating a little bit of interest income, basically. Because sometimes it's just actually better to receive the interest, especially when the interest rates with the Fed and everything are a little bit on the higher side, than actually pay off your debt if it's at a relatively low expense rate there. But here's 130 million, and I usually like to look for about a 1 to 10 from the operating income to the net interest expense. So they're a little bit outside of that. So that's not basically super ideal in my opinion. So they could. I wouldn't be expecting them to take on a lot of debt anytime basically in the future, because if they were, for example, wanted to do an acquisition and they've taken a lot of debt, well, because they already have, we can see what their interest expense is. We kind of get an idea of how much debt they're going to have too. And we know their next basically round of debt they would get would probably not be at very favorable rates. So they might actually choose to do some dilution for an acquisition rather than taking out a large amount of debt. Although they do have a little bit of wiggle room, but I would not say it is actually that much compared to this 130 or even 155 million to only basically 988 basically million in operating income. And then we kind of get more to basically the bottom line. You can see anyways, tax rates fluctuate. 17-18% seems like a pretty normalized one they would experience in the future. And they're bringing around at net income $663 million and net income at the bottom line there, and that's just under a 20% margin. Again, this is a little bit on the higher side they've had in the past, so I think this is sitting basically pretty well. And before I go too far, just if you see some of these other years when it was a little bit more further off, it's usually because you have some large kind of other operating income expense, which can be a write-off or a one-time thing. Right now, you can see there's sometimes this 50 million. A lot of this sometimes is just writing off basically goodwill as things go on. So we're going to have to look at the cash flow statement for that, but just kind of keep in mind when you do see large fluctuations basically in the net income, that's typically caused basically by other operating basically income or expense. So you kind of need to see what that is and see kind of normalize that, so it's not throwing off what you're seeing in that current year or basically past years. And we can see over the last years, at least since 2021, they have actually bought back a lot of shares, and that's why in the 3-year buyback rate, we are seeing it was averaging basically 6%, because they brought it down from over $300 million to $250 million. So that's a good sign, because it means they're basically making money, which we can basically see, and they're buying back shares with it. And the stock's right now at least sitting, we are, it's all there. Maybe buying back here wasn't the best time, but anytime after 2022 or at least 2023 going forward was probably a little bit more attractive time to basically be buying back shares. And that does appear actually in the last few years where the majority of their buybacks basically have occurred. So that is looking like it's a overall good basically allocation of capital they've been relatively doing. So let's check out the balance sheet, basically see if there's anything we're noticing that's good or bad about this. We can see current assets staying at 1.4 billion. And as we already said, they do have some basic interest income, which is in cash and cash equivalents, basically, which basically means they probably own some government treasuries, and that's why they're making the interest off those. And they're effectively probably getting a better interest rate than they would be, paying off their debt. A lot of times when companies, they do have a smaller amount of debt, they're able to get at very favorable interest rates. And if they go in the past with interest rates are lower, you don't necessarily want to pay off that debt when you can actually make a higher interest just by investing basically in treasuries. So, they're sitting at $1.4 billion basically in total current assets, yeah, there's some receivables, but it's mostly cash. And compared to their current liabilities, the current liabilities are only $907 million. So this is a very healthy current ratio. And then we get to basically the total long-term assets. Total long-term assets are sitting at a little bit under $3 billion. Where they did bring up goodwill before. You kind of, and this is kind of like a web type company with a lot of websites. You do have to realize a lot of this is basically just goodwill, and this is just kind of what goes on the balance sheet doesn't actually have any tangible application when they have done basically acquisitions or when they buy a company and pay above the book value. Doesn't mean they're basically overpaying for it because they get those cash flows from it, but you do have to kind of take that into account from the balance sheet perspective, that even though it looks like they have this almost $3 billion of total basically long-term assets, it's not actual physical tangible assets. They do have some actual other intangibles, but their actual gross property, plant, and equipment is sitting under $500 million. So a lot of this is basically goodwill, and you would see it basically written down, and that's probably why you have those other basically expenses 1 year off, because according to the accounting regulations, they do have to kind of write off goodwill if the assets they have aren't producing the kind of the expected incomes they would. And that's why sometimes the goodwill, as you can see, will creep down a little bit over time. And if they do acquisitions, well, it's going to basically pop back up again. And when we go to total liabilities, you can see it actually is higher, sitting at $3.7 billion. And this is because they do have a little chunk of basically long-term debt here at $3.5 billion here. And this is paid down a little bit from the last few years. And like I was saying before, with their net interest expense to income ratio, I wouldn't be expecting them to take on a lot more debt anytime soon. And you can see actually as we get into the thing here, that kind of has been the case, and they've actually been paying it down. And this may be a trend. Well, they paid it down a little bit more and it came back up. Sometimes this is just they're rolling over basically some debt, for example. But I would want to probably see this kind of creep down a little bit in the future, because right now they are sitting at negative total equity of $218 million. And if you were to actually take out the goodwill there, they would be sitting at about $2.5 billion of negative equity, which I do think is quite important to take into account, because their market cap is just under $10 billion. So when you're kind of looking at that $10 billion market cap, kind of from a book value perspective, they're kind of negative $2.5 billion. So this is something that I do think is significant enough that probably would basically garner them a lower PE ratio basically because of that. Of course, unless they start paying back a little bit more of that debt and improve this basically the negative equity a little bit more. So that's kind of a little bit negative for them. Not the healthiest basically balance sheet out there. Well, from the short-term perspective, they have the cash and they're going to be able to basically pay all their debts and everything. There's going to be no problems there. They don't really have a lot of wiggle room to take on a lot more debt. And it's definitely, I think, being a little bit of a negative towards the company valuation with the negative equity they have once we factor in goodwill. So let's get down to the cash flow statement. And, this is where things get a little bit more interesting. And, for a company like this, the cash flow from depreciation, because they have some offices for their employees, this and that, it's going to be a pretty minimal impact. And the only thing we really want to check here is basically what is the cash flow from depreciation and what is the purchase of plant, property, and equipment. And pretty much for the most part, if we average this out, it really just looks like it's at replacement value. So there's nothing abnormal happening there. Sometimes you can see if there's some, funny business going on, because this can basically influence if it's higher or lower your purchase of plant, property, and equipment of what your actual real cash flow is happening at the end of the day. Because all these other things, that changes in receivables and working capital, may fluctuate year to year. But sometimes we can notice trends in the depreciation and purchase of plant, property, and equipment. But we're not noticing basically any for Match Group here, because it's quite minor and they're quite in line. The one thing I would kind of keep track of here is the stock-based compensation is quite high. As you can see right now, that means basically to offset this, they have to do a lot of share buybacks to basically offset this, because, well, they're making, $663 million in, net income here. They're almost $250 million in stock-based compensation. So the stock-based compensation basically since 2020 has gone up quite high. And that means basically they do have to buy back a lot of shares. And if they were ever to just to basically offset that, and if they were ever to get into the case where their operating income wasn't as high, you would actually start seeing this act as quite a dilute effect basically going forward in the future. But the positive of basically, again, the stock-based compensation is that, well, from a cash flow perspective, they're going to actually have a lot of excess cash since a lot of their expenses they're just paying with stock and not actual cash. So that does create a little bit of a safety buffer for them. If they were to experience some turbulent times, you would just experience a little bit more dilution during those periods of time. And then when it comes down to purchase of businesses, as I was basically saying, this is where all the goodwill came from. And this is very important since this is kind of a lot of what's going to be the company's potential growth strategies. And you can kind of see they do acquisitions that do happen over time. And, there might be more that, happen in the future. If there's a new big dating platform that suddenly gets hot, well, I would assume Match Group may actually be one of the ones who would try to basically, acquire them. And, that would probably be the objective of that dating platform, is to get the market share and then sell out to a company like them, as, that's kind of how the business cycle works. But you can see there's actually not really been any significant ones since 2021. These little ones, 2022 and 2023, quite minimal, but they haven't done any. And again, it's going to be harder for them to do any like really, really basically large ones like this, unless they're going to kind of dilute it, because they're already they're a little bit high in the debt. And if interest rates remain high, they wouldn't be able to get very favorable rates. So if they were to do a larger acquisition, it probably would be most likely a little bit more stock-based comp. They may do a little bit of cash too, but it's very likely it basically could be stock-based comp, which would be dilutive in that way, or they're just going to hold off on it and keep developing their own platforms, as we kind of see from the money they were spending on the research and development. So there's not a lot happening, basically, at least that in the short term, but it is something to kind of see what they're doing in the future. And you got to also remember that a lot of times when basically companies do acquire other businesses, they always do so at a premium, and that causes the company itself to basically drop in stock price. So you kind of have that little bit of a double-edged sword right now for Match Group, that they're kind of a little bit of a slow grower right now. And if they were to do an acquisition, that probably would create a temporary drop in the stock price when they would announce it, since they would have to be paying a premium. And when it comes down to the more bottom line here, you can basically see they are repurchasing a lot of stock the last few years. And at least in 2021, when the stock was the highest price, they basically were buying back the stock, and they kind of did more start deploying the capital when the stock price was a little bit on the lower side. So I think that is a little bit, shows a little bit good usage basically of their capital in that perspective. And, the cash flow from dividends, they basically just started paying a dividend here. And I think basically it's so low right now, they would probably maintain this dividend. 2%, close to 2% there actually is, not bad, because the company has a lower PE. So definitely this dividend, I would not, the problem is I was just about to say, I wouldn't expect them to cut it, but in the past here, they've kind of been on and off paying the dividend and cutting the dividend and paying the dividend and cutting the dividend. So typically, well, a lot of companies, they like, once they implement the dividend out there, they don't like to cut it. For a company like Match Group, who's never had a consistent dividend, you never know actually what they're going to basically do. But as long as they're kind of like, have this like strong free cash flow here, which is, at almost at $1 billion because of all that stock-based compensation, well, they're basically just going to be dumping that into, repurchase of shares and a little bit excess of the dividend. And for a lot of people, it actually is much more effective to basically do the return as a repurchase of shares. So I think that is one good thing that basically Match Group is doing. So, overall, the, company has, its pros, its cons, and a lot of it just depends on, this model of, is there going to be any big disruption in online dating with all these different platforms they own? As they own more and more and more of them in different countries and different like niches and everything across the world, they get more solidified basically and more consistent, which kind of appears to be in the stage they're in. So I think from the business and the money they're making, it's good. Balance sheet's a little bit of a detractor because of the debt and the negative equity, though. So let's more for the valuation. Let's get into the interactive chart here. And the revenue with estimate here will bring up the analyst estimates. And you can see they're expecting it to grow basically not very much the next year, but then accelerate going forward. And I will just say, from what I've basically seen, how a lot of the times analysts estimate things, is you can't always rely on these types of estimates basically after the first 2 years, because typically they think that, oh yeah, it's going to basically grow at this kind of rate going forward in the future, which is a little bit under 10%. Let's 3.6 to that. This year is expected to be 10, called 5 or 6%. But in the current year, they're expecting things to basically almost be flat. And the problem is you get when in this type of cycle here is they really don't know when things are going to accelerate again. Things could actually maintain flat for a while longer, and that would then probably cause the stock price basically to drop. So I would say these are the analyst estimates basically right now. But just from the short-term ones here, that they're expecting it to be flat, even down a little bit in the year, this basically does mean that these ones could potentially be high because there actually is no real estimate of when things are going to pick up. It's basically just a guess going forward in the future. So let's take that away and let's start looking at a few other things. We can pop up with dividend yield again because they kind of cut their dividend and re-implement it. Not very relevant in the long-term scheme of things. Like for a lot of stocks, you can say, oh, the dividend's basically high, it's a good time to buy. Low, vice versa. But with inconsistent dividend history, you really can't bank on that type of estimate there. And now that we're from the revenue, let's go with the EPS without NRI with estimate. And it's kind of saying the same story again. The EPS is expected to actually grow at a lot faster rate because they're expecting to buy back shares. And again, I think there's just the same issue that you probably, even if they were to maintain the revenue basically flat, they still would be able to grow the EPS because they would still be able to buy back shares. And you also got to remember, if they were to revise down their growth estimates, well, the stock price would drop and they would actually be able to buy back more shares, which basically would still keep them in the positive EPS growth stage, maybe just not at this higher expected rate. Since a lot of these ones here, once we get to the end of year ending 2026, are expecting 267, then to 308, which is basically over 10% jump. Then we're going from 308 to 357. Again, that's close to 50, around 15%, and then almost another 15% jump there. So they are expecting the EPS to grow at quite a good clip, which does require basically those buybacks basically to occur along with that stronger estimated revenue growth. And let's look at a few more of the metrics here. Oops, thing just refreshed on me. That's fine. And let's look at the price to earnings ratio because 15 can seem like a cheap PE, and let's just bring this a little bit shorter time frame. I don't know, like 20. Let's go 15 years here. And the thing is, you can see right now basically the PE there. And if you ignore these really high points here, like basically when Match Group was growing really well, kind of this 2017 to 2020 period here, it traded up to as high as a 40 PE, even in the mid to basically the high 20s a lot of the time. So I kind of think that would be a good estimate to put if they were to kind of enter a growth cycle again, that these are the upper kind of P ranges that you basically could estimate. But then on the other side there, if they aren't in one of those cycles there has been a lot of times when, again, they've been in this 14, 12, 10, kind of 15 average P ratio. And let's actually bring up a little bit longer time here. You're going to need to cut off, all that time and pre-2000 or pre-2008. And you can see even back here in 2005, it got down to under a 10P ratio. So, that isn't something that would be super abnormal to basically happen to Match Group if they were to get some, estimates down and basically revenue growth, or, if there's a little bit hit to EPS there. 15, it's kind of like a fair valuation, I would say, for a company which is in a slower basically growth rate. We can look at the price to sales ratio here, and you can basically see it's a lot of it has been multiple expansion. It's contracted down. Well, it is higher than these other periods. You kind of do have to remember that the net margins have significantly changed. So if we look at the net margin on the bottom line here, let me just get that and that away. And you can see we're sitting at 17.5 here, and it's higher than it has been in the past. And this here it's 6%, 5%, 6%, 9%. There's some higher boosts here, but on average it was probably at least half of what it was in the past. So, being at a 2.9 or almost 3 price to sales ratio from these historical perspectives is fairly normal. So I'm not really seeing that the company is abnormally cheap or abnormally expensive. And you can see from this little short-term trend here, it's kind of basically been bouncing back and forth. So basically with that, we can get into, well, I'll bring up my basically not discounted cash flow calculator, but this is the discounted kind of earnings expectation calculator. And this is, based on the 2030 EPS estimates, which might be a little bit high. And if those were to basically occur, I think it would be very reasonable for it to trade between a 20 and 30P ratio. And that would definitely garner, between, 19% to 30% compounded annual growth rate per year on the stock price, basically, if it were to get up to, again, these P ratios in that much time. That's because, the EPS would be compounding at, 12.21%, which over 10% EPS, basic compound annual growth rate expectations typically do garner around a 30p ratio. But again, the real risk is like I was saying before, is that the analysts are kind of expecting the current year to be flat. Oh, and then for things to reaccelerate. But a lot of times what happens is, oh, well, they're expected flat this year. Well, they can still end up being flat next year as well. So you kind of need to start estimating a little bit of those possible expectations in. So let's just, for example, just play around with this, put in a 3.5 here. And as you can see, this would bring this down to then, a 6.7% EPS growth, which I think would be a lower growth rate estimation. And then 20 PE seems a little bit on the higher side. And then your expected returns really don't get very too far away, 13.2%, a little bit more in line with the market. And, so that's kind of what you'd be getting for that. So I don't think it's actually a terrible long-term buy here. I'm not personally buying it myself, and we'll get into the chart for a little bit of kind of stock technical analysis here, and you can kind of see its long-term trend, which I think is fairly, representative of the stock. It's had these cycles up, you can see cycles down or sideways, and right now it's had a big cycle down, and this might be in a cycle sideways for a little while longer. And there's nothing really saying that, oh, this pops up a little bit and comes back, and there could be quite a few more years of it potentially kind of going sideways before it pops up. From a long-term perspective, reverting back to this mean trend, there's definitely a lot of upside to that, but I think you do have to be more looking at like a 10-year basically outcome for something like Match Group for that to occur. And that doesn't necessarily guarantee a super high rate of return. It could be, below that 15%. And when you're buying individual stocks, that can be a little bit more risky. But this is a stock I've been watching, and as you can see, it's kind of coming back and forth. And I would kind of say from just the technical perspective here, you can see it was like, lower low, lower low, lower low, lower low. Oh, we got a higher low now. Well, now what I would want to be seeing now is I would want to see, a little higher low around here. And that's probably then when I would be interested in getting it, since the stock price would be a little lower, the earnings would be a little bit higher, and that would mean the PE would probably be getting a little bit closer to, for example, a 10 versus a 15, which I think that adds, quite a bit, buffer and margin basically to that. And it's like, well, you could have bought it any of these times basically at the, similar price back here, but you also have to realize there is like, a time value to money. So if you buy it too early, even if it goes sideways, which does happen to me with a lot of stocks, I buy it at a good price, but then you go sideways for 3 years. Well, you have your money sitting there, and it's basically not making any money. You're not losing anything, which is great, but you're not making anything either. And I haven't really been seeing like Match Group as anything that's just going to explode up and run away. But definitely, if they were to make a little bit of this like next low here, that probably is when I would personally be looked at maybe dipping into it. And if we kind of draw a little channel here, you can kind of see how, that would potentially happen. Maybe it gets around up to here, gets into some of these resistance levels here, and then comes back here. And you see the price volume profile. There's been a very, very large, basically, demand for the stock around this $30 range. And anyways, like, I have a lot of other stocks, basically, I have right now. And if they were to come back down to the $30 range, that's when, I would personally want to buy it. And I think it would be good, to potentially hold for the long term, even if it flounders around for a little bit. But as soon as they kind of get a little spark of growth basically happening, that's when you could experience one of these runs basically potentially happen. And well, maybe as I say this, maybe they're starting one of those right now. I don't really know, but right now, I think $40 again is like a little bit more of the fair value. If we were to come down to 30, that does become a lot more basically, or like 31, a lot more attractive price. So anyways, those are my thoughts on Match Group and the stock analysis. You have a little bit of, the fundamentals, technicals, the valuation there. So I hope that gave you a few insights into this stock. If you are looking at it, that can just give you some potential ideas of at least what I'm seeing that's happening behind the scenes in their financials, and what I'm personally basically planning on doing with my own allocation to the stock potentially in the future. So make sure to subscribe to the channel, like the video, and I will see you in the next stock analysis.